You've got the non-farm payrolls coming in at 199,000. And, well, we've got just the person to help us break it down. Take a look at the data here and then market reaction too, as well as Fed implications. Scott Bauer is here, CEO of Prosper Trading Academy. Scott, thanks for sharing part of your busy Friday morning with us. Let's just break it down. Ben. First and foremost, what jumps out at you? It looks like it came a little higher than expected.
It is a little higher, but you know what? I have to wait to see what the breakdown is, because there was a lot of talk about with the auto workers settling,
UAW
and the UAW, the actors strike, that could play into this number here. Overall, Ben, I think this is a great number, and here's the reason why. Yes, the market wants to see the continuation of bad news, good news, with a lower number here. And I don't know what the wages component is of this, but this is a moderate number. This is a very moderate number, slightly higher than expected. So those of us, I'm in that camp, that was concerned about, this continuing softer news, bad news, actually being good news for the marketplace. But then down the road, whether it's a couple
bad
months,
news on the bigger picture.
Exactly. I think this moderates that.
I like that.
I don't mind seeing this number. And in fact, this sell-off that we see this morning here, I would be really surprised if that continues. I would bet we see a bounce as this number is digested more, but we have to see what other components, are making this up.
Scott, sounds like you're saying a little bit of a balance to some of the disappointing data that we saw earlier in the week in terms of JOLTS, ADP, Challenger, and that theme that we had been talking about in terms of labor conditions slowing, but not necessarily so hot that it's going to raise concerns, right? It didn't come in above 100, 200,000, that kind of key psychological threshold, I guess one could argue in many ways.
Absolutely. I mean, look at the 10-year right now. The 10-year is bumped up to 4.25,
yeah,
4.25 right here.
Yeah.
Yeah, I wouldn't be surprised if that's back under 420 by the end of the day here. I could be wrong here. I think this is a really good number overall for the economy, for the market. And this is something, again, we have to see the wages component, unemployment. I really like this, and I think we rally off of this later in the day.
Well, down to 62 in reaction to, but we're hanging out right around 45.70 here. So to your point, just off the highs that we saw, 45.93, kind of in the middle of the range, right? Not extending the losses that we saw initially in reaction to the number as well. Scott, I've got some information for you because you mentioned you didn't see the average hourly earnings. Well, I'm here to tell you they balanced that narrative out quite a bit as well. I'm taking a look because, for one, I'm noticing that the year-over-year number down-ticked. Average hourly earnings was at 4.1 to 4.0. And then this month's number came in line with expected at 4.0. So a little bit of easing in terms of some of those inflationary pressures there. Nothing major, but down 0.1% for the revision, I think, is going to be key. Now, in terms of the average hourly earnings month over month, it did come in a little higher than expected at 0.3, up from the prior level of 0.2. But again, to your point, maybe not anything there to necessarily derail some of the momentum or that kind of underlying bigger picture that we've seen.
And you know what? Powell has to be sitting back, as you and I talked about yesterday. Yeah. He's sitting back in his chair with a big cigar in his mouth right now, because this, for him, is a Goldilocks number, because he can come out next Wednesday after the Fed meeting and say, you know what, we're making progress. We're not there yet. We saw a little bit of an uptick in the jobs report. We're fighting it. Status quo. So this is perfect for him. Again, I think this is a real positive number here, Ben. It's going to be, in my opinion, a buying opportunity a little bit on this dip here. And you know what? We move forward. We've got CPI next week. And what we have is something that has been so closely watched in the marketplace over the last several months. Excuse me. We've got a bunch of bond auction on Monday. 10-year, we've got a bunch of those. So you know what? The marketplace is really looking to that next. And we'll see what happens. But next week's going to be a big one.
Yeah, I want to talk a little bit more about next week here in just a second, but one last point on the jobs here, because I did notice the participation rate, which actually upticked here to 62.8% from 62.7. So again, maybe nothing to get too concerned about, but just a thought that we raised earlier in the show, Scott. If the headlines are showing, and we're seeing all this talk about how there's fewer jobs out there, in theory, those that are still looking for them are going to be a bit more aggressive, right? My son, for example, he's looking for employment right now. And any opportunity that comes out, if he's hearing there's fewer and fewer opportunities available, they're going to be more likely to jump on them. Yeah.
Yep. No question. And maybe more likely to, for the younger generation, your son, my kids, to jump on it and be more apt to getting into the office and doing what's necessary.
A more traditional environment, yeah.
Exactly, for what the employer wants, and not
which
necessarily
is good for the overall
at,
economy in general.
I agree.
Yeah.
I totally agree. I think this is a really good number, as good as it could be.
And then on top of that, one could argue that that participation rate increasing could put some pressure on the wages in theory. So speaking again to that point in terms of balance, Scott, talk to me a little bit about the week ahead, right? Because we always talk about how one data point does not a trend make, and this sort of does kind of counter or kind of balance out some of the trend that we had been seeing this week. But I guess I'm wondering here, last big release for the year, or the Fed next week? I mean, after that, do we just shut it down?
We've got CPI Fed, and like I said, we've got some real big bond auctions next week. So next week will be a big one, and then we kind of shut it down. Then we go into holiday mode. Is Santa Claus coming, which is at the end of the month? But you know what? There's a lot of time left between now and when Powell speaks next Wednesday to have a big market reaction here. So, let's see what happens here. But again, Ben, I think the trajectory, once this is all dissected here, I'd be really surprised if we don't make this back up today and actually end in the green in the markets today.
Scott, appreciate you joining us here. I know it's a busy Friday morning, and it's much, again, for us here on the network, for you to put time aside to help us break it down, take a look at the numbers, and share your perspective. Scott Bauer, CEO of Prosper Trading Academy, joining us this Friday.